Good morning, good afternoon, good evening. Welcome to this RVW special presentation. Just to start, I must make the statement that the SEC requires us to make, which is past performance is not indicative of likely future returns. Don't ever invest until you're fully familiar with what you're doing and have read carefully all the offering documents. And the materials here are not complete and should not be relied on without the supplemental materials. Having said that, let's jump right in. First of all, just my own heritage that I think will give you a sense of my perspective because it is a little different from most. I bought my first shares when I was 14 years old in South Africa, a company called Irvin and Johnson that is still around to this day. When I was in high school, my teacher and I bought 100 shares together. He trusted me. He said, "You do the research and I'm in with you." And that company, I'm happy to tell you, is still going strong. So I have a long, long history. In fact, when I was a student at the University of Cape Town, I was selling mutual funds to my parents' friends. I go back a long way, and I've probably seen more bull and more bear markets and heard more bull than most people watching the show. And so, with probably 60 years of experience in this business, I'm happy to be the lead presenter and to take you through some of the facts, some of the data that we believe is important for now. We've got to get beyond the headlines and we've got to get to the fundamentals. We are data driven, and I think you're going to be kind of overwhelmed, perhaps, although there are replays available, with the data that will portray where we are, how we got here, and what might happen. With that having been said, we called our company RVW after Rip Van Winkle because peace of mind is everything. And the peaceful sleep that we know our clients have, and by the way, we've had very few calls over the last week, which is a great tribute to our educational process and the style of investing that we employ and advocate. Very few. But our goal and the lesson we learned from our RIP is peaceful sleep is the most valuable asset you can have. And that's our promise to our clients. And you'll get a sense of what peace of mind means in today's turbulence. We are, of course, in the middle of a Trump induced collapse of the stock market. We're probably either in or will be possibly in a bear market. And of course, as you will find out, bear markets are nothing to fear. They happen every now and again. And the most important thing is to ignore them if your investment has been if your portfolio has been properly constructed. We will be talking about what properly constructed portfolios look like. First of all, in terms of looking at the problem is enormous. This isn't a fabricated problem that we're looking at. Our exports are significantly less than our imports, significantly. Now, they're not as bad as one might think, because although we're very, very negative on goods exports as opposed to goods imports, the real makeup for that is service exports and service imports, and that brings the gap down significantly. But if you can take a look over here, we have a surplus of service imports and a deficit of goods exports, and those two together create a combined total deficit, which is this first pink line over here, which of course is significant. And as you can see, not only is it bad, but it's trending in the bad direction. And here you see the goods, just goods, with the major trading partners. As you would expect, China's at the top, and then the European Union, and then Mexico, and so on. You can see them going down, and very few that we have a positive goods relationship with. But these are all evidence of the problem, and as I said, it's a serious problem. Now, how we pay for all of these excess imports is by sending treasury bills around the world. And if I were a cartoonist, I would have a cartoon drawing, and I'm not a cartoonist, of ships bringing stuff into the United States from these countries and us sending back treasury bills. And so they own a huge amount of American debt. Once again, a problem that's not going away and does need to be dealt with. And here you see it. Now, the good news is we're relatively independent of international trade. You will see that the United States is only 11% dependent on our exports. Germany at the top is 43% dependent on its exports. And so we're relatively self-sufficient. We're oil self-sufficient, and in most things, we are self-sufficient. There are some important areas where we're not, like rare earth minerals. which are needed for the whole digital technology and high tech. But basically, we're pretty much a self-sufficient economy, as you see. Um, Part of the problem is, and this is straight from the Wall Street Journal a few days ago, Americans buy a crazy amount of cheap stuff. The article is incredible. It talks about how much stuff we buy. We then store all the excess in the self-storage units, which is another obsession we have, keeping all of our stuff and accumulating it. And one of the things they said was things are so cheap and so easy to order that for many people, instead of looking for anything, they simply buy more from Amazon. And so you see it over here. Take a look at how much more we're spending on dishes and flatware than we did in 1995. Personal care products and furniture. There's no reason that we should be spending this much more, except for an attitude of what I would call the great disposable society. Um, Tariffs, as you can see, will be the highest that they've been in over 100 years. And this is a very dramatic increase and will have severe repercussions. Let's talk about the implications of tariffs. First of all, there are some pros. And as you will see, this is not a political conversation. It's an investment and economic presentation. There are pros to tariffs, and they are sometimes necessary. First of all, there are sometimes domestic industries that need to be protected. Certain local manufacturers need protection because if we have a strategic industry, for example, or a critically important industry or a very large employer, and we're paying $15, $20 an hour, and we're competing against China with $2 to $3 a day or something like that, it's unfair to the local producers, and we need to have what I would call a cost equalization tariff. Then we have a tariff to increase revenue. And these are some other reasons is the government needs revenue, so they impose tariffs as a source of revenue, which, by the way, ends up being a disguised income tax. Because the way that really works is the government gets the revenue, and then the merchandise all gets passed down to the consumers who pay more for it because of the increased tariffs. And therefore, in a sense, it's a disguised income tax. And then because of the need to improve your trade balance. If you're constantly importing more than you're exporting and sending out all of these treasury bills, there may be a need to change your trade balance. Now let's take a look at the cons. As I said, higher costs for consumers because the consumers ultimately pay. That's where everything ends up. You can have retaliations. We're already seeing them. And you can also have supply chain disruptions. And we will deal with those a little more right here. So the possible consequences can be divided into first order reaction, second order reaction, and as you will see, third order reaction. So the first order reaction are the most immediate things. Other countries retaliate with tariffs of their own. And that, of course, has its own implications. And then, as a result of the first order reaction, there are second order reactions. Those are consequences to the consequence. And over here, US exporters lose competitiveness abroad, leading to declining revenues because now we're facing tariffs that we didn't before overseas. Supply chain shifts, many of which are fundamental, and we'll see those. We're already seeing those. Increased lobbying and political action. And rising consumer prices. So those are second order reactions. And then third order are the really big, massive, long-term complex consequences where you have realignments of countries to form new competitive trading blocks, possibly a loss of decline of the value of the dollar as the global currency, as other blocks come into being, geopolitical shifts in terms of the political power and military power and all of the other macro changes, innovation and efficiency pressures, investing in automation, reshoring, which means moving stuff in different parts of the world, and central bank adjustments, because what we're dealing with also is the possibility of currency changes. Don't forget the high dollar has made it easy for us to import massive amounts of goods inexpensively. And there are people who believe that the real problem is simply an overvalued dollar. So just to put all of those in perspective as we move around. We also have a domestic debt problem, not only an international one. And here you see the US government spends more than it brings in. Once again, unsustainable. So both as a country, internationally, compared to the others, and as a government, We're spending beyond our means. Those are problems. Of course, when you solve problems, there are two ways to deal with them. One is incrementally, I would call surgically, and the other one is with a sledgehammer, what I would call amputation. And let's take a look at what that means. First of all, I want to share just very briefly the Warren Buffett input at times like this. I'm not going to read you the whole poem, but he cites this poem pretty often, written over 100 years ago. And the first line basically tells you what it's about. If you can keep your head when all about you are losing theirs. And then it goes on about what you do when crises happen. He has a couple of other interesting comments, and I'll try to get to them later. But one of them, relative particularly to the very overpriced Magnificent Seven, was when he says, trees don't grow to the sky. Nothing keeps growing at the kind of rate that was built into the expectations for some of the most favored companies over the last 3 or 4 years. Nothing grows forever to the sky. And we're facing that right now. Um, so let's deal with mindset before we get into specifics. Basically, what most people do is they buy at the peak because that's when it's most exciting. That's when the euphoria of a bull market hits in. And as they say rather crudely, the masses, them asses, most people climb in at the top. And then when the market goes down, that's when you have your peak selling. Most people end up buying at the top, selling at the bottom because that's what the instinct tells them to do. And they can't figure out why Buffett's rich and they're having bad experiences. By the way, we learned this from the animal kingdom. I come from South Africa, as you probably know, and I've been on safari many times. What I learned from safaris, when animals feel comfortable, they herd. And when they sense danger, they flee. That is our instinct, and that's what most people do. And so, the desired mindset that we seek is equanimity. Ignore the market prices because in the long run, as you will see, they always treat you well, provided that your portfolio is properly constructed. And we will deal with that. Equanimity is the mindset that Charlie Munger advocates and which we embrace. It is the mental calmness, the composure, and evenness of temper resulting from an approach that really deals with the long term and ignores the short-term noise. Here's a quote which I wanted to read, and this is the last of the quotes for a while. History repeats and repeats, forget it. All bubbles break, all investment frenzies pass away, and our challenge as investors is to survive until sanity resumes, which it always does. I'm going to hand over to Jonathan now, who will pick this up, and I will be back. Thanks, everybody. You will hear more from me, but Jonathan's going to deal with the essence of market volatility, how and why it works, and how to react to it.
Okay. Thanks, Dad, and thank you, everyone, for joining us. Volatility is the price we pay for extraordinary results over time. It doesn't come free. One must be buckled in to this turbulent ride to a glorious destination and pay attention to what data to absorb and when to not react. That equanimity comment my father mentioned a moment ago. There was a day in 1998 when Warren Buffett's holdings in Berkshire declined by $6.2 billion. But how much did he lose? Nothing, because he didn't react and he didn't sell. And it was an academic data point on a big, long, upward trending slide. If my grandmother had invested $1 in 1926 in large cap equities, that $1 would have grown to $18,000, just $1, just $1. And had we invested in small cap during that same 100-year run, it would have been almost twice that, almost $40,000 for every $1 invested. But look at the alternatives. Bonds would have grown to a mere $128, hardly a rounding error compared to the equity results during that same period. And the vertical lines on this chart show what were really believed to have been and what felt like truly existential events. Truly. And if you look at each one of them, at the time, they thought markets, market participants, populations, it's different this time. And yet the equity markets continued to march on forward and upwards, because what we're really investing in is fantastic, strong businesses and their management teams and their abilities to continue to grow in an ever-changing environment. And here too, although there's real change that seems to be here, and it feels like it's different this time, so too each of those historical events felt different then. Here you see again an illustration of $10,000 invested in 1970, and each of the vertical lines, and I'm happy, by the way, please follow up with any of us. I'll send you the data. We can spend more time looking at these. But each of these vertical lines represents a catastrophic, a frightening, a seemingly different this time event. And yet that $10,000 since 1970 would have grown if it invested in the S&P by an annualized rate of almost 11% to $2.8 million. But there's another thing in terms of timing. Had you gotten in right here, and I'm sure you can see my slide cursor, but in 2008, just before the decline, and you had invested based on this chart, something like $500,000, something like that, $500,000 on just the worst day, just before the collapse. Still too, that $500,000 approximately would have been almost $3 million. And the key is that volatility is the price we pay to participate in this trend. This, anyone who spent time with me, is my absolute most informing, and this is my North Star when it comes to equity investing. You can see that in 1980 through today, the blue lines, if you can ignore the orange, represent the performance of the S&P 500 in each year going back to 1980. This is sort of my life. And you can see that the average, if you would draw a trend line across just the blue lines, ignore the orange, is right around 10 or 11%. That's a fantastic result. But now let's introduce the orange lines. The orange lines are the price we pay for that, which is the intra-year decline. It's the drop for the worst moment of each and every year. And if you pay attention, for example, just to the 1980s column on the left, the blue line tells you that the full year result was a full 26%, January to December. But there was a moment during 1980 that the markets declined by 17%. And if you had gotten out, you would have realized that 17% and paid the price. But if you had done nothing, you would have clanked your champagne flute, celebrating, welcoming in 1981 with a 26% result. It's the same point I made a moment ago, where Buffett, in theory, on paper, lost $6.2 billion during that fateful July and August. It was irrelevant because he stayed the course. If you're willing to endure that momentary intra-year decline, which averages 14%, then you're worthy or entitled to that annualized growth of 10% over time. And that's the key. You must be willing to pay the price of volatility in order to inure or win that upward trend. Another fantastic slide, which very much informs how we approach equity investing, is this bulls versus bears since the Second World War. If you look at this slide, it's basically one big blue graph with very little orange interruption. Now let's interpret the colors. You can see that the blue represents bull markets. By the way, they're called bulls because bulls kill up and bears strike down. That's the lore. That's how we were taught. The average bull market going back to 1943 lasts 4.3 years and delivers 150% results of appreciation. Fantastic. 4.3 years of growth delivering 150% growth. What's the price? You must be willing to endure an average of an 11-month decline, giving up 31%. That's the historical data. That's the historical data. But what's more, and what's very interesting about the designers of this informative graph, is the vertical gray bars. And I want to point out that the vertical gray bars are economic declines or contractions or recessions. And what you can see is that while they commonly overlap with bears, they don't always. There is not a one-to-one correlation between recession and bear markets. And what I encourage you to own, really intellectually own, is that equity markets and economies are very distinct. They interplay, but they're distinct. And what we're really buying, what we're really investing in, is great businesses with fantastic leadership teams, and they will thrive in whatever economic market or tariff environment we present them. You have to stay the course in order to remain an equity investor. That equanimity word my father introduced, it's critical. In this nearly 50-year run from 1979 through today, if you had remained invested in all days, $10,000 in the left bar would have grown to nearly $2 million. Fantastic results. But let's jump to the right graph, the right bar for a quick moment. In nearly 50 years, if you had missed just 50 of the best trading days, that $10,000 over 50 years would have grown to $115,000, a meager, pitiful result over that period. 50 days in nearly 50 years produced almost all of the growth. Equity markets perform in spurts. This is not a normal upward trending, smooth result like the acceleration of a car or a ride up an elevator. That's not the experience you ought to expect in equity markets. They come sudden spurts in an unpredictable way, producing massive, massive leaps forward, and yes, jumps backward as well to achieve those leaps forward. And markets don't go up all the time, but they move up over time. And it's not timing the market, it's time in the market. And the markets have evolved. And the evolution, the scientific, the research surrounding equity market investing has very much informed how we approach things. We don't buy individual stocks here at RVW Wealth because individual stocks have their moments and then they cycle out because it's a dynamic world. What we do is we rely on the science of capital markets to inform how we select in huge numbers. And we look for factors and features in large numbers. Think, this large LLMs, large language models. This is informing everything we do in AI and big data sets. Well, it informs how we've been running equity markets since we entered this business in 2006. And rather than looking for individual businesses or anomalies, we look for large numbers. And we look at things like free cash flow. If you can identify large numbers of businesses who exhibit this feature of free cash flow, cash in excess of what they need to operate, those have historically proven to be good businesses. And if we look for companies that exhibit strong momentum, just like the principle in physics, those have historically tended to be better ways to select stocks than other ways. And if you look at businesses that exhibit not just dividends, but growing dividends in numbers over time, those have proven to be a great way to select businesses over time. And why do we use those dynamic systems to filter large number of businesses into the businesses we own? Because companies have their moments. My father mentioned it earlier. Great Warren Buffett says it frequently. Trees don't grow to the skies. If you look at the businesses, this chart I have in front of you very much informs how we select, how we expect businesses to grow. But if you look at, this is the top 10 businesses by decade. And in 1980, the biggest businesses, IBM, AT&T, Exxon, Standard Oil, Schlumberger, Shell, Mobil, Atlantic Rich. Not one of them is a company that I want to own in large numbers today. Mobil, yes, Mobil is still considered to be a good company. And certainly not companies I expect my kids or grandkids to recognize the names of. And so too, if you look at the current businesses as of 2020, there may be some rotation as a result of the tariffs or other external forces. Maybe the idea that Apple manufactures phones in China, brings them over here and makes a massive markup. Maybe that's coming to an end. Maybe. We don't know. But what we do know is what systems do we use to continue to filter and highlight and feature the best businesses in the world, whatever they happen to be at that time. And the ETF systems we use for equity investing is the best way we know to do that dynamic real-time selection so that you're not stuck holding the bag with Nippon Telegraph stock over the next decade or whatever that next business is, which fades out. And buying just the S&P 500, oh boy, that we learned that lesson in the 2000s. If you had the S&P 500 from 2000 to 2009, that 10-year run, it was virtually the only asset class that lost money over that decade, virtually. Compared to mid-cap, small-cap, emerging markets, and international, those each, and I'll cite them in order, delivered 85, 160, or 17% results over that period, whereas the S&P lost 1% per year over that period on average. And the lesson is, what is the S&P? Is it the best way to invest? And what you find in these moments of stress is what the S&P really is a focus on a handful of really, really big businesses. And what you find you're doing is stock picking based on size alone, ignoring some of the other attributes that we feature and that I just mentioned a moment ago. And this is a great lesson that we're all feeling. Many of us are feeling. Not us at RVW, because we've never focused on the S&P as a selection tool. But stock markets are like watching a man walk up the stairs with a yo-yo in his hand. You have to watch the feet and not the yo-yo. Otherwise, your neck will be very, very sore. I love this graphic. We are privileged here in the United States. The blue bubbles are the businesses we proudly have domiciled here in the United States. We are 4% of the world population. 4%. And look at what percentage of the world brands we own. The resources, the systems, the infrastructure we have here in the United States, and the brands that are here, we are positioned in the world. While many are concerned about the future position in the world, it is so strong. We are going into this with strength and dominance and a position relative to world order that really we're going into this in a very, very good place. And so are our households. Here you can see household balance sheets as measured by liquidity and total assets is as strong as it's been for a hell of a long time. The average household has a liquid, strong financial position. Again, with all of this unrest with the world order, not only is our world position going into this strong, but the households within it are strong. And here's more data. Again, a little bit hard to see on the screen and study in great detail, but please call us and we'll go through it together. And the inclusion of AI, artificial intelligence, in every business, every single business is rapidly growing. It reminds me, when I was younger, we studied Moore's Law, the advancement of computer processing power in our machines was doubling so frequently. Here too, we seem to see that same trend on AI, how it's being adopted and incorporated into every type of business, every infrastructure, every consumer. It's just wild. It's wild. And that is one of the driving forces, which in spite of tariffs or taxes or changes in regime, gives us great confidence that the businesses we buy and their management teams will have a continue and growing ability to do well over time because they're incorporating things like AI into their resilience. And of course, that's impacting how we're doing pharma and bio research. This is an interesting slide. We debated how to include it. The fact that our longevity is rising should be a fearful discussion point from a financial planning perspective. But look at this. The pharmaceutical companies into which we invest have a huge number of drugs in the pipeline. They will figure it out, whether they're producing them here or in Europe or in Asia. That will be driven by the tariffs. But what won't change is that these businesses will continue to innovate and develop and produce fantastic products that will enhance our lives. And that's very much what we do. And Dad, I'll turn it over to you after this, but we've seen the play before. And I started by saying it always feels different this time. And it does feel different this time. The narrative, the text, the subtext, it all feels different, but we know how it ends, which is the bulls will dominate. The businesses we buy will be resilient and will retool and reinvent and onshore if necessary and offshore if necessary. But that's what we're betting on because we know we've seen the play before. It always ends the same way. Dad, over to you.
Yep, there we go. Thanks, John. Yeah. So I wanted to introduce Jesse Picanco. He's one of our most senior analysts and a part of our team at the inner level. He's a CFA, which is a chartered financial analyst. We think of that as a PhD in finance, and he's going to be dealing with some of the other elements of the portfolio because up to now, what we've discussed is equities because that's what people are reading about. That's what people are emotionally involved. But portfolios should not just have equities. In fact, people say, what do we do now? And the answer is if you're wondering what to do now, you're in the hands of the wrong investment advisor because this should have been anticipated as a possibility. Anybody who invests in equities should know that every now and again, in the most unexpected way and at the most unexpected time, the market will go down. And if you're not prepared for that financially and emotionally and educationally, then you are with the wrong people. And so, as John says, this is the way the story of equities always ends, but there are other elements of the portfolio. And I want to introduce Jesse, who's going to be dealing with us, and then I will come back at the end to wrap up. Thanks, John.
Good morning, everyone. Thank you for joining us this morning. I appreciate you and your presence. Before I begin, I just want to dovetail two comments from Selwyn and Jonathan. One is the AI comment, and one is the fact that our trade deficit is sending treasuries to foreign countries as we take goods. So as they were speaking, I used ChatGPT to create a cartoon to visualize that. So everyone is definitely enhanced by the use of AI. And of course, I'm being facetious, but I thought it was kind of funny. Now, when RVW uses alternative investments, we are trying to reduce volatility and gain access to markets not available in public securities. And we've been doing this for a while, and we've been proactive, recognizing that the equity markets are volatile, and we would like to generate the same returns, but with less volatility. So that is how and why we engage in alternatives. Specifically, we've been using private credit, real estate, and infrastructure. Infrastructure is a newer addition to our portfolios, but we think it's a very interesting and exciting aspect. Private credit generates strong income. Real estate gives us diversification into income-producing properties, and infrastructure gives us access to the future economy. And I'll go into each of these individually. Now, first, I'd like to point out that when RVW uses alternatives, which can have high fees, we always engage in what's called the institutional class, the Class I share classes that have no upfront fees and no commissions. If you go to any other non-fiduciary investor, they're likely to charge you up to 3.5% in commission right to the broker. We do not have anything like that in our investment lineup. Now, first, let's talk about private credit. Private credit are loans to small and medium-sized companies. 15 years ago, you would have just called it banking, but because of onerous straitjacket requirements based on that occurred during the financial crisis, there are independent investors specializing in these kind of loans. The loans are floating rate with high yields. They are often or almost always senior secured and have a diversified exposure to the different borrowers. This is a cross-section of some of the loans in our portfolio. In this portfolio, the average EBITDA, that's profits of the borrowing companies, is $107 million. That means they are not venture capitals. They are not, we're not guessing that these companies might be profitable. They are already very profitable companies. 95% of the loans are first lien, so that we are first in line in case there's any corporate distress. The loan to value of these loans is 41%. That means if the company itself was valued twice as much as it should have been, the recoveries should still be very strong. One of our portfolios has 3,800 different borrowers, and of which 5.4% make up the top 10 positions. So it's extremely well diversified. And as you can see, the current distribution rate is 10%, which is a very attractive income cash flow for our clients. The portfolio is also extremely well diversified across industries and sectors. What's notable is that it has a very low allocation to energy and real estate. Now, why is that? The reason is the lenders are very careful about only lending to companies where they know they are growing and they're not susceptible to outside forces. With energy and real estate, there's a lot of outside factors that affect the value of the loans. With energy, you're susceptible to the price of oil or the price of natural gas, and the investors, the lenders are unsure, or they're not in the job of predicting energy markets. So they invest in companies or areas where they can guess that the company themselves will be growing and very strong regardless of the economic fundamentals or the macroeconomic fundamentals. Now, when we invest in real estate, we are looking for low correlation to other asset classes, inflation adjusted cash flows, good returns from the underlying assets, and more stability compared to other asset classes. Historically, the income component of real estate has outperformed inflation, and that's what we're looking for. We're looking for cash flows that are stable and can generate cash flows that are at least going to be doing much better than inflation returns. When we're looking at individual properties and portfolios, what we want is diversification, but especially we want to look for low office and retail exposure. So we're very careful about how the portfolios are allocated and what their strengths are and how they're taking advantage of different macro environments. For example, some of our portfolios have reduced exposure to industrials or apartments and put money into data centers. These portfolios are surprisingly nimble, and they can access areas that we can never replicate on our own. And they can also do it in a way that's flexible and forward-looking. And we appreciate how these portfolios can provide diversification with hundreds or thousands of different properties in their portfolios and provide a very strong, stable cash flow. When we're looking at infrastructure, it's similar to real estate, except the demand is also often necessity based, where the buyers of these facilities or assets have no other choice but to use these facilities. They're very capital intensive, which means there's not much competition for engaging in these properties. Meanwhile, the cash flows are often regulated with long-term contracts that ensure the stability of the pricing and the value of the assets. And meanwhile, these assets are also appreciating and investing in new capacity, which increases the value of the investment. Although when we think of infrastructure, we often think of bridges and tunnels. When we are investing, we are thinking thematically, specifically and most importantly in the digital transformation that requires investments in data centers, cell towers, and fiber, but also the energy component of that, which requires new generation facilities and the transmission mechanisms to get the energy to the data centers. And in addition, the replacement and enhancement of aging infrastructure. So we're not strictly looking for any type of project. We were only looking things that make sense in a growing, forward-looking economy. Historically, private infrastructure has done very well, and it's only recently that it's available to investors that aren't institutional class. Historically, private infrastructure has generated a 10% return compared to 8% in public equity. So we're very excited about this opportunity now. So as we invest in alternatives, it's not just diversification, although that's a very strong benefit. For different clients, it provides different things, and we invest accordingly. For example, private credit is an exceptional income generator. Real estate and infrastructure will also provide growth. All of these assets provide access to markets that we could never do in the public markets. And because of its low correlation to equities, it provides stability without giving up too much return compared to the public market. So we're very excited about alternatives as appropriate for our clients. Now, Selwyn, back to you.
Thanks, Jesse, for that. I thought I would just wrap up by just mentioning to everybody the following. First of all, as you saw, the economy is strong. We have a dynamic environment. As the economists say, America is the best place to open a business because not only can you open it easily, but you can close it easily. There are many countries where getting out of a business is almost impossible. It's an entrepreneurial environment. The infrastructure is strong. Keep in mind that in times of disruption, fortunes are made. Just remember that. In times of when tariffs are imposed, and I've lived in a tariff-imposed country for a large part of my life, there are many companies that do very well. And the beauty of our system of equity investing is to seek the companies that are rising to the top. If you'll allow me once more to give you a safari or an African image, when you go on safari and you look at the plains of Africa during those migrations, you see huge animal populations moving across the plains of Africa, and you know that the animals at the front of the pack are the perfect specimens. And as you look towards the back of the pack, you get to what they call in the army the sick, lame, and lazy. And at the very back of the pack are the fodder for the predator following them. I want you to know that what we're about at RVW is doing whatever we can to move our portfolios towards the front of the pack. And as companies begin to fail the tests of the various funds because their dividends are not growing, or their profits are shrinking, or their footprint is going bad, or they don't have a strong balance sheet anymore, any of the tests that are constantly being applied to our companies in the ETFs we use, as soon as they fail those, they are dropped. And they're dropped or decreased in a tax-free manner because of the way that ETFs are structured. So not only do we seek to optimize return in a dynamic way, kind of a Darwinian best of breed type of way is the tendency of our portfolio, but it's done in a tax optimized manner. Bear in mind, RVW was born out of a CPA firm, and we always have one eye on the tax implications. Tax minimization is a critical part of wealth optimization. We're there. Diversification, as you saw, doesn't eliminate risk, but what you want is non-correlated risk. You want to have different risks so that they don't all manifest at the same time. And so just keep all of those things in mind. Keep in mind that we don't just do equities. A properly constructed portfolio has buckets for safety, for growth, and for income. And melding those is the job of a great wealth manager. Thank you for your time. We're available to answer any questions. A replay of this is available. And I will just end as I started. This is not complete, should not be relied upon, but we're available to give you the complete and information that you can rely on. And we'd be delighted to hear from anybody with any questions. Remember the key word from Warren Buffett's partner, Charlie Munger, equanimity. The best thing you can do if you've got a well-constructed portfolio, and that is the key. If you've got a well-constructed portfolio, this should have been anticipated and incorporated into the planning. And with that, I wish you a good weekend. Let's hope that everything gets resolved as quickly as possible and efficiently as possible. But as I always tell people, we don't predict, we prepare. Our investors are prepared, and we're prepared, and we're hoping for a good and productive outcome to this, which is possible. And certainly that's our first prize. But whatever happens, we'll be prepared because there's something in the portfolio that will respond well. And over time, America has always recovered. We are America, the greatest experiment the world has ever seen. Thank you, and God bless.